Let's just keep it simple and let's talk about whether taking more investment risk is better than an approach that just focuses on providing a secure and stable base of income.
Yeah.
And I've been one of those who have said, we've done well in the United States with our stock investments. There have been these historical periods where stocks over the course of 20 years have done great, mainly in the middle of the 20th century and on the lead up to the tech bubble, between the late 1970s and the late 1990s.
Yeah.
So between 1934 and 1953, if you had put a dollar into the stock market, it never grew to an amount less than $7 over the next 20 years. Since the late 1980s, not once has a dollar invested in the S&P 500 grown to more than $7 over the next 20 years. So
Wow.
oftentimes the mistake that people make is that they use these historical stock returns to project how much income you'll be able to generate from your investments in the future. And that's just not realistic anymore. In a world where everybody's investing in stocks in their 401k, and there's, you can invest in mutual funds for almost no costs and ETFs. You can create a well-diversified portfolio of stocks for almost nothing. That's way different than it was even in the early 1970s. So it makes sense that the expected return, the reward that you need to get for investing in risky assets, is going to be less in the future. That's my belief. It's a belief of a lot of other people. And what that means is that if you run an analysis that shows how much income you can generate from an investment portfolio safely, that analysis may be using data that are no longer relevant in the future. I would rather base my lifestyle in retirement on those mortality credits, being part of the long life income club, being able to spend more because I'm part of the long life income club, because that doesn't depend on what happens in the market. If
Right.
you invest in money and you take financial risk, on average, historically, you're going to be able to spend more than if you'd taken no risk, but there's certainly no guarantee that you'll spend more than if you took advantage of those mortality credits. And there is a significant probability that you'll spend a lot less if the markets don't do well. I
Yeah.
used to tell people when I gave presentations on retirement income planning that if you pick up the wrong card at the very beginning of retirement, so in other words, imagine that you've got 40 playing cards, and on the back of each card is printed a return on your retirement portfolio. And two of them have negative 20% return on them. One of them has negative 30% return on them. If you pick up the negative 20% return card, then the probability of success might go from 95% down to 69%. If you pick up
Yeah.
the negative 30% card, the probability of success goes from 95% down to 48%. So that's
Wow.
less than a 50-50 chance that you're going to be able to spend that amount of money that you thought was safe simply because you picked up the wrong card. And I'll tell you, there are retirees who retired in 2021 during the pandemic because the market had done so well in 2021 who took risks. They invested in high yield bonds, and they invested in crypto, and then they took market risk. They picked up that negative 30% card the first year. That means they're going to have to cut back significantly on their spending if they want to maintain a decent chance that they're not going to run out. That's the trade-off that you have to be willing to accept when you take investment risk.